Hello and welcome back to The Breakfast Show. Yes, it is Tuesday. That means our friendly financial planner, Mr. Yap Ming Hui, is back on the show. Everybody make sure you pay attention.
That's right, that's right. 3 weeks in a row we've been talking about unit trust, and of course we wrap things up with the dispelling of some myths. Now, of course, when we talk about unit trust, you talk to friends who also are investing in unit trust. And of course, certain myths get thrust out there, and of course it's the job of our friendly financial planner to dispel those myths. First of all, once again, welcome on set, Mr. Yap Ming Hui, Mr. Financial Freedom himself. Thank you.
Hello, good morning. How are you?
I'm fine.
All right, we heard your public seminar went exceptionally well.
Yes, I got a few viewers on NTV7.
That's fantastic.
Also attended the show. I'm quite surprised to see them.
Yeah, all right. So they learned from The Breakfast Show, yeah?
Yes.
Good stuff, good stuff. All right, so now, for those who've been tuning in for the first time, maybe an overview of unit trust. Who should go for it, who shouldn't go for it?
Yes, is it for everybody?
I guess unit trust is one of the very convenient unit trusts that everybody should consider investing if you got spare money. But like what I mentioned, I think 3 weeks ago, you should invest into unit trust if you have got the money that you can put aside at least
for 6 months. 3 years.
3 years.
3 years.
More than 3 years.
Yes.
3 years is the
If you can make do without that X amount of money for 3 years, you know, then you should invest in unit trust.
Yes.
It's one of the best because it's considered quite low risk, you know, because it's you put eggs in different baskets.
Yeah, it's because it's actually quite diversified compared to you buy one single stock. It's also actually require you to actually come up with a smaller amount of money, and you can do regular saving along the way.
Excellent.
So that's make it quite convenient in that sense to invest.
Of course, with different dividends coming from different portfolios, but all depends on what you choose, right?
Sure.
All right, now let's go to the different myths. What is the number one? Well, we go to number 5 to number 1, like easiest. Number 5. What is the first myth?
I would say that, for example, I ask both of you. If there's actually 2 funds, Fund A and Fund B, actually one is actually 50 cents, one is actually 1 ringgit. Would you think that the one with the 50 cents actually have a higher chance to perform better?
Not
necessarily. Yeah, that's true.
Because this is actually one of the common perception that people have got. Just like when you buy shares, people used to think that, hey, if I buy a share with 50 cents,
so you have an opportunity to make more.
They have a higher potential to make compared to this one is really 1 ringgit. So actually it's more difficult. So one common myth about people investing in unit trust is that they always feel that the unit trust fund with lower price actually has got better potential to actually achieve the return and gain compared to the one with a higher price.
So that's not true, yeah?
That's not true. Totally not true at all. That's number 1.
Okay.
Number 2 is that some people actually, they like to buy a new fund. Just like people like buy new shares in IPO, so that this share normally will actually shoot up after 1 week or 2 weeks, things like that. So people have the same impression that when they invest in unit trust. So they think that if I buy the new unit trust fund, the turbo engine is there, the potential is very strong.
I see.
So then I buy old fund, all the steam is already out already, which is not really true. Because whether you're new or old, actually that's not determinant of the performance.
So what is the determinant then, if you don't mind me asking?
I would say actually between the new and old, I would say the new fund, honestly, you just hear of the story. Or this China fund actually is good, but you do not have a track record. You do not know in like down cycle how do they perform, in the up cycle whether they're really good. Actually, relatively an old fund, somehow you got more information. You can see, say for example, a fund with 5 years, you can see in 2008 how it has been doing.
How's the trend like
compared to the peers. And then they will see whether fund manager actually is really professional in doing that. So relatively, I would say older fund compared to actually us, actually as a professional, we rather choose older fund with track record.
I see.
Because a newer fund is a higher risk.
Yes, because we don't know. Uncertainty. Yes.
But is there such a thing as a fund that is too old? Something that has been around too much. You know that it's peaked. Is that possible?
No, actually there's no such fund actually that has been too old. Actually and expire. As long as there's still a designated fund manager managing it. And if it actually achieving track record, we should actually continue to actually invest into this fund.
I see, I see. All right, so that's myth number 4, which is new funds do not necessarily perform better than old funds. So
now
we move on.
Myth number 3.
Myth number 3. Myth number 3 is that I'll ask both of you. If you invest in a share, stock, you declare dividend, will you be happy?
Well, of course, definitely.
Of course, isn't it? They give you 5%, 6%. This is like, wow, this is like extra that you get.
Yeah, exactly. Yeah.
But then in unit trust, you invest in unit trust fund, then they give you actually dividends. Should you be happy and excited?
Well, you tell us.
Now they're getting very smart already.
I want to see you, so I scared wrong.
So the idea is that some people got a perception is that if they buy a unit trust, just like they buy a share, when they declare dividend, it's a good news. You know, and actually the unit trust fund, they declare dividend, then actually it's a good. Good fund, which is not really true. You see, say for example, you've got actually a fund which is like the price now is 1 ringgit.
Yeah.
They may declare a dividend of say 30 cents. So actually at the end of declaring 30-cent dividends, the value of the unit trust fund become now 70 cents.
I see.
No? It's not like share. Share you may actually declare a dividend of actually 30 cents, but then the value of the share is still 1 ringgit.
I see.
So that's why declaring a dividends in the unit trust, it's just like giving your money back to you.
Exactly.
So when you add up the dividend plus the latest value of the price, you still get the same thing like before.
I see.
So, which means to say, the myth number 3, never think that a funds that declare dividends, okay, will give you a better performance
at the end of the day.
Yeah, it does not show any indication at all.
All right.
Okay.
That's a very valuable tip, actually. So we move on to myth number 2.
Okay, myth number 2 talk about a lot of people used to think that when I say that we should look at those funds that got the performance. Those actually got the track record. Then they may think that, Mr. Yap, then why don't I go to the newspapers, the unit trust performance table, no? Then I go and see like the Leapers, like Morningstar. Then I see the fund, the top one, no? Then I go and buy. Sure, I make money because it's top performing fund.
Yes.
Which is not really true as well.
I see.
Because those top performing funds, for example, top 1 to top 5, past good performance does not guarantee future good results.
So, are we talking about short term versus long term? Or are we talking about overall?
Yeah, I would say that actually we need to be very sure that past performance, especially past short term performance, definitely does not guarantee a future good result. Okay, because whatever actually past actually is a past. But so that's why we must not. I actually got a client who used to work with me maybe 10 years ago when I was actually still very new in industry. We both like sitting down, looking at the table, and pick those funds. The top one. You say this one cannot be wrong. We were very excited. 6 months down the road, this one become like almost the bottom. So this is really hard lesson learned from the client. But that was 10 years ago. Now I become more smarter already.
Okay.
There you go. But of course, it's things they learn that you share with us.
But there's one second part of biology add to this particular myth. Even though past good performance does not really guarantee good future result, but I can assure you, if you got like funds that you got, which now having lousy performance, past, for example, you invest for 3 years, is doing very lousy, then I can assure you that past bad, lousy performance definitely will not give you good result. So that one even for sure. So this part of the fund, you should definitely get rid of it.
Get rid of it.
Yes.
I see.
Yeah.
So past non-performing funds, which haven't been performing for some time, you should say cut your losses.
Cut the losses, and then liquidate them, and then look for a better fund to invest.
I see.
Okay.
All right.
And then which leads to our last
Number 1.
Number 1, I think one common myth is that some people think that unit trust, all unit trust fund is the same. So to them it's like, this is share, this is FD, this is unit trust.
I see.
So they think it's one type of actually asset class, which is not true. Because under unit trust, in the broad item, you have got equities.
Yes.
You have got bond.
Yes.
You have got money market.
Yes.
And all 3 of these has got different risks, different return potential. And even under equity fund, you have got Malaysia equity,
that's true,
blue chip equity, you got small cap, then you got also like country fund, China fund, India fund, Vietnam fund.
Yes.
You got regional fund, Far East, Middle East,
Pacific,
Europe, and things like that. And you got global equity.
Yes.
So for your information, you know how many funds out there?
Just a round number.
Yeah, round number. There are more than 600 funds.
Oh my goodness gracious!
Out there, and these are all different.
Wow.
Okay, so to lump unit trust just under another form of investment, and of course to compare it to just FD and to shares is a very, very big mistake. And that's the number one myth that you should be conquering if you want to be dabbling in unit trust. Yeah?
Exactly.
Yes.
All right. Thank you very much for shedding a lot of light into this. Of course, let's just recap on some of the things Mr. Yap has said, of course. First, a low entry price for unit trust means a far better chance of making returns. Well, they're not stocks. So it doesn't mean that, you know, the common rule of buying low, you sell high, doesn't work with you.
Exactly.
Yes.
Right. Another myth that we have debunked today is just because it's a new fund doesn't mean that it will be, it will perform better than the rest. If you were to choose between a newer fund and an old fund has, of course, a track record you can check. It's actually wiser to go for the old one.
All right, so the next one that we want to highlight here, the more dividends declared by a unit trust doesn't mean it's a performing fund. Yeah, that's very important indeed, especially if it cuts into your profits. In the end, you end up with less. So far, are we on track, Mr. Yap?
Yeah, which means to say once you actually declare dividend, okay, whatever that you have got plus the dividend you get, you still end up having the original value.
Same amount.
Same amount. No more, no less. Nothing to be excited about.
Okay. Next one, the short-term performance for any fund is not an indication of long-term good performance. But at the same time, Mr. Yap has also said that funds that have not been performing will definitely not perform over the long term. So time to cut your losses, yeah?
Yes.
All right. So have we been good students so far, Mr. Yap?
Yes, I think you have been very smart students. Yeah, I look forward to teach more.
Thank you, Seafood. Thank you.
Let's hope that it all transfers and we can convert this to money and have results the next time that we see you.
That's the whole thing about translating whatever knowledge you acquire, apply into the real practice, and then make more money from
the sky is the limit then for our viewers. Once again, thank you very much, Mr. Yap, for all the time you spent here on The Breakfast Show, educating our viewers. And I hope our viewers have appreciated some of the tips that we've shared with you as far as, your quest for financial freedom. Good luck, and of course, try to keep a level head when it comes to investing, and of course, never spend more than you earn.
And if you still want some more information on Mr. Yap and the work that he does, or if you want to chart your roadmap to financial freedom, make sure you visit his website. It's www.yapminghui.com.
All right, it's on our on our screens at the moment, or you can, of course, contact Mr. Yap via email as well at inquiries@yapminghui.com. So far, you've gotten a lot of inquiries.
Tons, right?
Yes, not tons. Inquiries. So that's for the benefit of the viewers today. If you got some unit trust investment that you have invested, but you'll be looking at it, don't know what to do with it. You've got some question about that. So feel free to send an email to enquiry@yapminghui.com. So I'll be most pleased to actually give my view, my comment on that.
Because one thing that we have learned from you, and that was either last week or the week before that, is that you as the investor, you really need to know as much as you can about your fund. Don't leave it to the consultant, who is actually the salesperson, or the fund manager, who will only manage the fund. So you need to be,
leave your money with somebody else. That's always open invitation to danger. Okay, stranger danger. Okay, once again, thank you, Mr. Yap. And we're going to go for a break here on The Breakfast Show.